Hello everyone, nice to see you again, welcome back to our next weekly session. What do we have for today? We've mastered revenue, discounts, returns and unearned revenue. Today we flip the coin and talk about costs, the other half of every income statement that directly impacts the profits. But let's recap what we know about the income statement. Yes, again, don't hate me, recaps are useful. In a simple P&L, revenue sits on top, so top line. Then we subtract discounts and returns, costs and tax and reach net profit. End result, bottom line. That's it, we have a summary of transactions over a period of time. Now let's talk costs. Earlier we were talking about the costs as simply costs. In fact, what we were always referring to was the cost of apples we were selling. This cost has a dedicated name to it, cost of sales or COS or cost of goods sold, COGS. They have the same meaning for the income statement. These are direct costs. They are incurred by us to buy and deliver to our customer the apples which we have sold to him. Easy to identify and see. But please be careful here. Timing is everything in accounting. Purchasing apples doesn't count as costs until you sell the apples. No sale, no cost of sales. If only purchased, they sit in inventory. In general, there are three major cost buckets you'll hear all the time. The first one, COGS or cost of sales. This is a direct cost of sold products or services, in our case apples. In real life that would also include packing and transporting the apples. Everything needed to bring the apple into the shape, get it to the customer and complete the transaction. The second bucket, operating expenses, also called OPEX. These are costs necessary to run your company whether you sell apples or not. That could be your own salary, rent, marketing, IT expenses, etc. Again, you have these costs irrespectively whether you sell apples or not. Often, they are also called overheads, like the costs on top of the cost of sales. And these expenses are also often allocated into subcategories. General and administrative or G&A, sales and marketing or S&D, research and development or R&D. And the third bucket, non-cash expenses like depreciation. For example, when you buy equipment which you use over several years, you distribute the cost of this equipment over these years. You have already paid the cash all at once when you bought it, but expense it over the years you use the equipment. For example, delivery truck you have bought. If it cost you $3,600 and you use it for 3 years, you would expense $1,200 a year or $100 a month, not the whole amount at once. This type of costs we will cover in later sessions. Another way to look at costs is direct and non-direct costs. As the name states, direct costs are going straight to a product. Cost of sales is normally a direct cost. Other categories are known as indirect costs. They are supporting the business, but do not really contribute to the sold product or service as such. However, sometimes indirect costs get allocated across goods, apples in our case, so total cost equals total resources used. And there is yet another way to classify costs: variable and fixed. Variable costs rise with every apple sold or decrease with no sales. This would be the product costs, packaging. They are one-to-one impacted by the number of apples you sell and depend on sales. Fixed costs, on the other hand, stay steady in the short run and don't depend on whether you sell apples or not. These costs could include your management salary, rent of the warehouse where you store your apples, accounting software. Knowing which is which helps you predict profit as sales volumes change. So, your extended income statement now may look like this. By deducting cost of sales or direct costs from net revenue, you will receive a result which is usually called gross profit. Gross profit shows how much you can earn by considering only the direct costs triggered by sales, and how much you have left to cover other expenses. Now, you further deduct other operating expenses. Personnel expenses, marketing, rent, IT costs, depreciation, and so on. And now you will get to operating profit. And then tax, and after tax to net profit. See how every cost found its slot? This way we record the costs by their nature. whether it's salaries or rent or IT or communication costs or any other. From such presentation of an income statement, we can see where our costs go, who or what is consuming our expenses. Alternatively, you can show your P&L by function, like this. Below gross profit we record general and administrative expenses, then sales and marketing, then research and development. If the business has all of these, of course. These functions will then include portions of different costs. For example, notice that we no longer have personnel costs on the P&L. They will now be split by function depending on what people do in the company. The $20 from the previous P&L could be split evenly by $5 per function, if our team is doing general administration with the same effort as sales and marketing. And that's why $80 of cost of sales now increased to $85. $5 of personnel costs are added to the cost of apples. For example, salaries of the delivery truck drivers. And you see that the profit didn't change, as the costs were only reallocated and moved into different buckets. The total stays the same. By presenting costs by function, we show what exactly the costs are driving, why they have been incurred. And remember, accounting loves timing rules. Costs should appear in the same period as the revenue they helped create. That's the matching principle. For example, back to apples. When you buy them, they sit on the balance sheet as inventory. Only the moment you sell them, their cost slides into COGS. Another example, big assets give value over several years. For example, delivery truck worth $3,600. If it serves you for 3 years, you then expense 1/3 of its value every year, $1,200 per year. And remember, some costs move cash, for example buying apples or paying wages, and some don't, for example depreciation of a truck. That's why profit doesn't mean cash flow, but that's a topic for another series. Okay, we can consider the basics of costs accomplished. A big effort today. Let's summarize it. Cost of goods sold, or COGS, plus operating expenses, or OPEX, equals total cost on a P&L. Costs should always match the revenue period to which they relate. Costs by nature show who and what, costs by function show why. The split of costs into direct and indirect and variable and fixed costs help understand profitability better. Not all costs move cash. For example, depreciation is not resulting in a cash flow. Thank you for watching. We hope this lesson helped clarify how costs affect the income statement. Don't forget to like and subscribe for more lessons on accounting and finance. See you next week.